क्या आप IAS की तैयारी कर रहे हैं और कोचिंग इंस्टीट्यूट्स को 2.5 लाख तक की फीस नहीं पे करना चाहते? अगर हाँ, तो 22,500 रुपए में घर बैठ के StudyIQ के पेनड्राइव कोर्स के साथ आप IAS की तैयारी कर सकते हैं। आज ही विजिट करें StudyIQ.com।
Hello my dear friends and welcome to StudyIQ. In this lecture, we will analyze whether the growth of Indian economy would be slower than what is expected. Here we will discuss many macroeconomic factors and their performance, and we will see how this factors is going to influence the growth pattern of Indian economy. Many of these macroeconomic factors are separately discussed in many other lectures, but here we will bring all these macroeconomic factors together and we will analyze how the pattern of this macroeconomic factors are going to influence the growth structure of Indian economy and what is the expected growth rate of Indian economy during financial year 2019, that is 2018-19. Let us start. First of all, let us check the background of India's economic growth predictions. India, as we all know, is one among the fastest growing economies in the world. The World Bank has also estimated that India's growth will increase in the coming financial years. So, even at the global level, there is an eye on India's growth. And the performance of Indian economy was also very satisfactory, and all these reasons have led to many forecasts regarding India's growth, which should be very high in the coming years. But if we analyze the macroeconomic factors in the current scenario, we will feel that these growth predictions can go vague. So, we will analyze various macroeconomic factors in this lecture and we will see how this will impact the growth of Indian economy in the current financial year and also in the coming financial years. Now, coming to the macroeconomic factors. What is macroeconomic factors? Macroeconomic factors are those factors which affects the economy as a whole. So, macroeconomics is that branch of economics that deals with aggregates, economy as a whole. So, those factors which influences the entire economy, those factors are macroeconomic factors. So, we will see what are the macroeconomic factors that are impacting our economy in the current scenario. The first one is the bond yield. So, we will discuss about it. If you remember the lecture on bond yields, there we had discussed that bond yields go up when bond value comes down. If you don't have a clarity on the basic concepts of bond yield and bond value, please refer to the lecture on bonds. You will get a clear understanding of how bond yields influence bond value or what is the relationship between bond yields and bond value. But for your understanding, there is an inverse relationship between bond yields and bond value. So, it means when the bond yield increases, the bond value comes down, and when the bond yield decreases, the bond value goes up. Now, the bond yields in the economy are spiking or increasing, which means the bond values are coming down. And this will have a negative influence on the economy, on the investments, because when bond value comes down, there will be lesser capital that can be mobilized through bonds. So, this will affect the investments in the economy and thereby economic growth. Now, second one is the depreciation of rupee. We are witnessing a phase where rupee is depreciated against the US dollars. It has crossed even the 70 mark. Now, what is meant by depreciation of rupee? Depreciation means value of rupee is coming down. And what is the reason for this decrease in the value of rupee? It is because the demand for rupee is coming down and it is a negative signal for economy. And if you remember, the finance minister had said that the recent depreciation of rupee is due to global factors or external factors, and therefore Indian economy need not be worried about the rupee depreciation. But even though it is because of external factors or global factors, the depreciation of rupee will impact the Indian economy in a negative manner. So, this is again second macroeconomic factor that is hampering the growth of Indian economy. We have discussed about the depreciation of rupee in detail in a different lecture. So if you want to have a clear understanding, a broad based understanding about rupee depreciation and growth, please refer to the video on depreciation of rupee. Now third one is expensive borrowing. The loan rates or the interest rates of the scheduled commercial banks have increased. There are many reasons for that. One reason is increase in the NPAs or non-performing assets. So when the non-performing assets in the banks increases, what will happen? The lending capacity of the banks will come down. When the lending capacity comes down, what happens? It has lesser capital to lend or money to lend. So in that case, what will the banks do? They will make the lending expensive. Again, second reason is that during the recent two monetary policy committee meetings, the two consecutive meetings of the monetary policy committee, they have hiked the interest rates. This was due to inflation in the economy. So the consumption of the economy have increased, and we have discussed it while we discussed about the growth of Indian economy in the quarter 1. It was 8.2% of the GDP. And it was mainly consumption driven growth. So inflation in the economy increased due to demand pull factors, that is the aggregate demand of the Indian economy increased, and therefore this has caused an increase in the prices leading to inflation. So due to these factors, the monetary policy committee in its two consecutive meetings, they have hiked the interest rates. So when the rates are hiked by monetary policy committee, what will the scheduled commercial banks do? They will also increase their interest rates. Now thirdly, recently the government has increased the interest rates on small savings schemes. So small savings schemes interest rates are connected with the government bonds. So when there is an interest hike in the small savings schemes, what will the scheduled commercial banks do? They will also increase their interest rates on savings. So the interest rates on savings accounts of the scheduled commercial banks will increase, and if the interest on savings increases, what will the bank do? Banks will increase the interest on lending as well, because the banks will have to give the interest to its depositors. And how banks will finance it? Through the lenders. So banks will obviously increase the lending rates. So all these factors has made borrowings from the scheduled commercial banks or financial institutions in the Indian economy very expensive. So borrowings have become expensive, and when borrowings are expensive, what is the impact on the economy? There will be lesser borrowings. Suppose if something becomes expensive, what will happen to the demand? We have learned that in the law of demand that it has a inverse relationship between price and quantity demanded. So when the price is high, quantity demanded will come down, and when the price is less, the quantity demanded will go up. In case of banks also, when the price of lending or expense of borrowing is high, what will happen? The quantity demanded will come down. So now borrowings are expensive, that means the price is high, therefore quantity demanded or the borrowings will come down. So when borrowings come down, what is the impact on Indian economy? The investments in the economy will come down, and when the investments in the economy comes down, there will be lesser production in the economy, leading to lesser output, and output is measured in terms of GDP, and GDP means the growth of the economy. So growth is measured in terms of GDP. So when investment comes down, production comes down, therefore output comes down, GDP comes down, and therefore the growth of the economy also comes down. Now next macroeconomic factor is the declining net foreign capital inflows. The economy is experiencing a decline in the net flows into the equity and mutual funds from foreign markets. If we analyze the economic survey last year, the survey projects that the FDI or foreign direct investments had come down in the previous year. But when it comes to FPI or foreign portfolio investment, the survey had estimated a growth rate of 78%, and therefore the survey makes a conclusion that due to such a huge expansion of the foreign portfolio investments in the Indian economy, the net foreign capital inflows has increased. So that was according to the economic survey last year. But if we analyze the current financial year, the current situation of the economy, we will see that the foreign portfolio investments are seeing or witnessing an outflow from the economy, and also the rate of inflows have come down. So outflows increased and inflows decreased. This is due to various reasons. One is the US monetary tightening policy, which we have discussed many times in different lectures. The US economy has tightened its monetary policy, making the money supply short in the economy. Therefore, investors from the US economy does not have enough capital to invest in emerging economies like India. And secondly, because the interest rates are high, the investors will prefer to invest in the US economy because the returns will be more in the US economy. That is one important reason, and various other reasons like depreciation of rupee, etc. Now, how this decline in net foreign capital inflows will impact growth of the economy? When the foreign capital inflows are high, it means there is more capital available in the economy. Therefore, the investments will be high. And more investments means more production. More production means more output. More output means more GDP, and therefore more growth. So, if the capital inflows from foreign countries decreases, what happens? The reverse of this happens. When capital is less, investments will go down, production will go down, output will come down, GDP will come down, and therefore the growth of the economy will also come down. Another important macroeconomic factor is the savings rate in the Indian economy. Economy is witnessing a declining savings in the bank deposits. We have seen one impact of demonetization was that the pattern of savings of the households changed. Earlier, the households used to save in the financial institutions like banks, but now the households are now saving into financial instruments like the mutual funds, bonds, etc. So this has affected the savings in the bank deposits. And what happens when the savings in the banks comes down, or when the bank deposit comes down? When the deposit in the banks are less, the banks will be able to provide only lesser loans. And lesser loans means lesser capital formation or lesser investments in the economy. And with lesser investments, the output will come down, and therefore GDP will come down, and the growth of the economy will also come down. And this declining savings in the financial institutions or banks is due to structural bottlenecks, and this can be addressed only over a longer period. Now, next factor is current account deficit widening. If we look at the trade deficits for the month of July, we will see that it was 5-year high. And in this trade deficit, it was not the oil or gold imports that had increased or widened the trade deficit, but it was non-oil and non-gold imports which had increased by 18.4%. So it is very clear that the import of consumer goods to the economy contributes a lot to the current account widening. If we analyze the trade deficit for the month of July, we will arrive at a conclusion that it was the import of consumer goods that had widened the trade deficit, particularly the import of electronics. And the import of electronics accounted for almost 1/10 of goods import bill. So, the import of consumer goods has increased in the economy. We will analyze the consumption factor of Indian economy in depth in this lecture itself. So, we will move on to the positive signs in the Indian economy. One propelling factor that has led to the growth of Indian economy is the consumption in the Indian economy. If we analyze the Q1 financial year GDP growth, which was 8.2%, we will see that it was mainly a consumption driven growth. So what happens when the consumption in an economy increases? Let us analyze. Let us take a demand curve DD with price P on the y-axis and quantity demanded Q on the x-axis. So here it is the DD or the demand curve. Let us also take a supply curve SS, and the point where the demand curve and supply curve meets is the equilibrium point. So here in this equilibrium point, we will see that price is P and quantity demanded is Q. But what happens when the quantity demanded or aggregate demand in the economy increases? The demand curve will move to the right. So a shift in the demand curve towards the right will happen and new equilibrium point will be E1. So at the new equilibrium point, we will see that the price is P1 and the quantity demanded is Q1. So this is what exactly happens when the aggregate demand in the economy moves up. The quantity demanded will increase, also the price will increase. So what will happen when quantity demanded increases? There will be more production taking place in the economy in order to meet the new demand, and with this new production levels, the output of the economy will increase and therefore the GDP will increase. So this is what has happened during the quarter 1 of the financial year with regard to the GDP growth of 8.2%. Now, what are the factors that contributed to this rise in the consumption levels? One reason was increase in the wages and pension of the government employees, especially after the recommendations of the 7th Pay Commission. The wages and the pensions of the government employees hiked after the implementation of the recommendations of 7th Pay Commission. And again, the government has increased the minimum support price in the agricultural sector. So this has increased the income of the farmers. Now the farmers' income has increased, therefore their purchasing power has increased. And this increase in the purchasing power will lead to more aggregate demand in the economy from the farmers or producers, and this will lead to increase in consumption. So these two are the important factors that has led to increase in the consumption levels in the economy. But what is the problem here? We have seen in the graph that when the quantity demanded increases, there was an increase in the price also. So there is inflation. Inflation means persistent rise in the prices of commodities in the market. So along with an increase in the quantity demanded, there was an increase in price as well. So what will happen when there is an inflation hike in the economy? When inflation is high in the economy, the RBI or the Monetary Policy Committee will hike the interest rates in order to contain the money supply. So money supply will come down, and therefore what will happen? The interest rates will go up. And with this new interest rates or increased interest rates, investments will come down. We have already discussed this concept. Investments will come down, therefore production will come down, and also output comes down with a decline in the GDP. And this consumption also have another negative impact. That is, this consumption can not only be from domestic resources but also from imports. So the current account deficit will widen if the consumption is backed up by imports from other countries. So imported consumption will widen the current account deficit, and we have seen it from the July trade deficit that the trade deficit has widened particularly because of import of non-oil and non-gold imports, that is import of consumer goods. So two implications, one is widening current account deficit and second one is inflation. So these two things needs to be taken care of while the consumption growth in the economy rises. It is positive for the economy because it will lead to higher levels of production in the economy, higher output levels in the economy, but along with that these two factors, that is current account deficit and the inflation, should be taken care of. Now what is the way ahead if we have to sustain the growth rates in Indian economy? The first one is to create a manufacturing capacity within the economy. This can improve the output levels and therefore the GDP will also improve. Again, this will reduce the imports from other countries and this will contain the current account deficit of the economy. So manufacturing capacity must be improved, but we have seen what are the challenges like lack of investment, expensive bank credit. So all these are challenges for this, and this can be achieved only in the longer run. Second one is to mobilize savings. We have seen the portfolio investments or the foreign portfolio investments to the economy is coming down. So the investment rate in the economy is coming down, and this has to be substituted by domestic savings. If the rate of domestic savings increases, these funds can be mobilized for investment investment purpose. So the government needs to take action in order to increase the savings rate in the economy. Remember, one main objective of nationalization of Indian banks was to mobilize savings, and it was fruitful also. So now the government and the RBI will have to step in order to increase the rate of domestic savings in the economy. The government will also have to focus on boosting the exports of the Indian economy. This is the only long-term and sustainable solution to contain the current account deficit. So exports should also be given focus, and for that it is important to create a manufacturing capacity within the economy. Now, the insolvency procedures must be strengthened. The government has recently come up with the IBC, Insolvency and Bankruptcy Code, Project Sashakt, etc. But the process must be furthermore strengthened, and this can improve the NPA situation or non-performing asset situation, the situation of the bad loans with the banks or financial institutions in the Indian economy. And if this problem is solved, the investments will come up because the bank's lending capacity will increase, and therefore investment rates will come up, and investments will create more production in the economy, and therefore GDP will increase, and it will also create more jobs in the economy, and this will help in creating a manufacturing capacity within the economy. Now, next one is to improve the public spending or the government spending. We have seen both private spending and also foreign investment in the Indian economy is coming down. First of all, coming to the private investment, the corporates does not have enough financial resources. That is one reason. Second one is the domestic corporate indebtedness. Thirdly, the corporate profits are also coming down, mainly because there is no relaxation to the labor laws. The manufacturing capacity is low. Lesser investments are done because the lending rates are very high. So all these factors has contributed to the decline in the investments by the corporate sector or the private sector. And we have also seen the foreign portfolio investments and the foreign direct investments into the economy are also coming down, and there is also an outflow of foreign portfolio investment. So in this scenario, what is the only solution in order to increase the infrastructure capacity of the economy? The government spending or the public spending. But one precaution the government must take is that when the government makes extra budgetary borrowings in order to fund the infrastructure, it can shoot the deficit targets of the government. The government is aiming for a fiscal consolidation, and extra borrowings in order to fund the infrastructure can be a challenge for fiscal consolidation. So this side effect must be kept in mind when the government makes extra borrowings in order to fund the infrastructure projects in the economy. You can find the PDF of this lecture on my Facebook page. Thank you.
क्या आप IAS की तैयारी कर रहे हैं और कोचिंग इंस्टीट्यूट्स को 2.5 लाख तक की फीस नहीं पे करना चाहते? अगर हाँ, तो 22,500 रुपए में घर बैठ के StudyIQ के पेन ड्राइव कोर्स के साथ आप IAS की तैयारी कर सकते हैं। आज ही विजिट करें StudyIQ.com।